Imagine it is 1987. You're sitting in a smoky piazza in Milan, espresso in hand, neon fashion everywhere, and the Italian economy feels unstoppable, loud, reckless, and drunk on its own success. Money is easy, credit is cheap, factories are humming, and Italy has just surpassed Britain to become the fifth largest economy on earth, convincing an entire generation that prosperity is permanent. You pay with a thick stack of lira that feels like toy money, laugh at inflation jokes, and quietly believe this party will never end because nothing around you suggests consequences exist. Now, smash cut to the present 2025, where the music has stopped, the lights are broken, and Italy is standing alone in the ruins of a party it never cleaned up. Italy is the only major developed economy that has barely grown for more than 2 decades, stuck in economic amber, while the rest of the world kept moving forward. While the United States roughly doubled its economic output since the turn of the millennium, Italy's income per person has barely budged since the era of flip phones and dial-up internet. This is not a temporary slowdown or a bad cycle. It is a slow-motion collapse that economists whisper about but politicians refuse to confront honestly. The uncomfortable truth is that Italy's downfall was not caused by bad luck, globalization, or even the euro itself, but by habits formed during its so-called golden age. Italy became addicted to an economic shortcut that made weakness look like strength and delay feel like success, an addiction rooted in its old national currency. Today we are performing an autopsy on the sick man of Europe, breaking down the 7 structural reasons why this beautiful country has been trapped in stagnation. To understand why Italy is failing today, you must first understand how it pretended to succeed for decades, powered not by innovation but by a printing press. In the 70s, 80s and early 90s, Italy did not win by becoming more productive, more efficient, or more technologically advanced than its competitors. Instead, it relied on competitive devaluation, quietly lowering the value of its currency whenever industry started falling behind foreign rivals. When Italian factories struggled against German precision or American scale, the solution was not reform or investment, but simply making the currency cheaper overnight. A weaker lira made Italian exports look competitive on paper, even when the underlying businesses were inefficient, outdated, and poorly managed. This trick worked for a long time, masking structural weakness and allowing small family firms to survive without ever modernizing or scaling up. But like any drug, the short-term relief came with devastating long-term side effects that Italy chose to ignore, while the highs kept coming. Devaluation imported inflation, raising prices across the economy and quietly eroding purchasing power for ordinary Italians year after year. To calm workers, the government indexed wages to inflation, creating a vicious cycle that locked the economy into permanent instability. By the early 1990s, the lira had become a punchline, setting the stage for a shock Italy was completely unprepared to survive. In the early 1990s, the lira collapsed during a brutal currency crisis, exposing how fragile Italy's economic miracle really was once confidence vanished and investors stopped believing the illusion. When Italy joined the euro at the turn of the millennium, it was like forcing a lifelong addict into sudden sobriety without therapy, preparation, or any idea how to function without the drug. Overnight, Italy lost its most powerful weapon, the ability to devalue its currency and hide inefficiency behind a weaker exchange rate. From that moment on, Italian companies had to compete with German and French firms based on real productivity, real technology, and real management quality. Decades of dependency left Italian industry unprepared, underinvested, and structurally weak when the easy fix disappeared. The euro did not break Italy, but it revealed what Italy had been avoiding for generations, an economy built on shortcuts rather than strength. This sudden exposure triggered the second fatal condition, a productivity collapse so severe it still shocks economists today. Since joining the euro, Italy's productivity growth has hovered around zero, meaning workers are not producing more value now than they did decades ago. In some sectors, productivity actually declined, an almost unheard of outcome in modern developed economies. While Germany, France, and even Spain steadily improved efficiency, Italy stood still as the global economy accelerated around it. This stagnation is not caused by laziness or lack of talent, but by the structure of Italian business itself. Italy is dominated by micro firms, tiny family businesses with fewer than 10 employees, romantic in image but brutal in economic reality. More than 9 out of 10 Italian companies fall into this category, making large-scale investment and innovation nearly impossible. A 5-person workshop cannot afford advanced automation, artificial intelligence systems, or serious research and development. These firms exist in survival mode, focused on making it through the year rather than building for the future. Staying small is not cultural nostalgia. It is rational self-defense against a state that punishes growth. Once a company crosses 15 employees, Italy's labour laws become a bureaucratic nightmare almost impossible to reverse. Firing underperforming workers becomes legally dangerous, union requirements explode, and administrative costs multiply. Faced with this trap, businesses choose stagnation, informality, or fragmentation rather than expansion. This deliberate smallness locks Italy into permanent inefficiency and guarantees productivity will never recover. If productivity stagnation is a chronic illness, Italy's demographic collapse is terminal because no economy can grow without young workers, new consumers, and future taxpayers entering the system. Italy is running out of people not slowly but rapidly, and the consequences are already visible in empty villages, closed schools, and towns fading into slums. You have seen the headlines offering houses for €1 in Sicily or Calabria, but those offers are not bargains, they are desperate cries for survival. These homes are cheap because the owners died, their children left decades ago, and there is simply no one left who wants to live there. Italy's fertility rate has collapsed to around 1.2 children per woman, far below the level needed to keep a population stable. Last year, fewer babies were born in Italy than at any time since the country was unified in the 19th century. Think about that reality. Modern Italy produced fewer children than during World Wars, pandemics, and national devastation. This demographic implosion is reshaping the entire economy into an inverted pyramid that cannot stand for long. In a healthy society, the many young workers support a smaller group of retirees, but in Italy, the base is shrinking while the top grows heavier every year. The result is a pension system stretched to the breaking point, absorbing nearly 17% of the national economic output. That money does not build infrastructure, fund innovation, or reduce taxes. It simply sustains promises made decades ago. Politically, this problem is untouchable because retirees represent the largest and most reliable voting bloc in the country. No elected government dares to reform pensions honestly, even as the math becomes impossible. Instead, policies have emerged that actually encourage earlier retirement in an already aging nation. These decisions make no economic sense, but they make perfect political sense in a system ruled by demographics. The burden falls entirely on the young, who face high taxes, low wages, and limited opportunity at the very start of their lives. With salaries stagnating and costs rising, young Italians delay marriage, delay children, or abandon the idea altogether. This feeds back into the demographic crisis, shrinking the workforce further and intensifying the fiscal pressure. The country becomes trapped in a self-reinforcing loop where aging creates stagnation and stagnation accelerates aging. Walking through provincial Italy today feels less like entering the future and more like wandering through a beautifully preserved museum. Even if Italy could fix productivity and demographics, anyone trying to build a business still collides with the uniquely Italian obstacle, a bureaucratic system so dense it suffocates initiative. Starting a company in Italy often feels less like entrepreneurship and more like navigating a legal labyrinth where the rules change while you're already lost. International rankings consistently place Italy near the bottom of advanced economies for ease of doing business and contract enforcement. The civil justice system is the clearest example of how time itself becomes an enemy of economic activity. If a client refuses to pay an invoice, Italian law technically protects you but practically abandons you. Resolving a commercial dispute can take more than 1,000 days, long enough to bankrupt a small firm before justice ever arrives. Appeals can stretch cases for years, rewarding bad actors who know delay as a weapon. This creates a culture where contracts are optional and trust becomes a liability rather than an asset. Honest businesses either price in the risk to avoid growth or exit the market entirely. Beyond courts, Italy suffers from a chronic addiction to regulation itself. The country has accumulated more than 150,000 laws, forming a legal jungle no entrepreneur can fully navigate. Even regulators struggle to determine what is legal, illegal, or temporarily permitted. Constant rule changes generate uncertainty, and uncertainty kills investment faster than taxes ever could. A recent housing renovation incentive exposed this dysfunction perfectly when regulations were rewritten dozens of times within 2 years. Banks froze, lending builders paused projects, and households were left paralyzed by shifting paperwork requirements. Foreign investors see this chaos and simply choose countries where the rules are clear and stable. Capital flows toward a predictability, not beauty culture or potential. Italy loses billions in foreign investment not because it lacks talent, but because the state cannot execute consistently. Bureaucracy becomes an invisible tax on time, and in modern economics, speed determines survival. While competitors move fast, Italy remains stuck in slow motion, sinking deeper into irrelevance. When opportunity disappears at home, the most capable people do what rational actors always do. They leave, triggering one of Italy's most painful wounds, the ongoing brain drain. Italy invests heavily in educating its young, producing, skilled engineers, scientists, doctors, and economists who are competitive anywhere in the world. Yet the moment these graduates are ready to contribute, Italy effectively gives them away to richer, faster, and more meritocratic economies. This is not migration driven by adventure, but by economic necessity and institutional frustration. A young engineer in Milan can earn a fraction of what the same skills commands just a short flight away in Northern Europe. The wage gap alone would be enough, but money's only part of the story driving young Italians out. Italy is governed by a gerontocracy where seniority matters more than talent and connections matter more than competence. Career progression is slow, opaque, and often disconnected from performance or innovation. Young professionals are expected to wait patiently for decades regardless of their ability or ambition. Many discover that their peak productive years will be spent as permanent juniors with limited independence. Faced with this reality, leaving becomes an act of survival rather than betrayal. Over the past decade, nearly 1 million Italians have emigrated, and the majority were young and educated. This exodus drains the economy of future entrepreneurs, innovators, and reformers. Fewer startups are created, fewer patents are filed, and fewer risks are taken inside Italy. The loss compounds itself because innovation thrives where talent clusters, and Italy is losing that critical mass. Those who remain are often trapped in precarious contracts with little security or upward mobility. Home ownership becomes unattainable, family formation is delayed, and long-term planning disappears. Ironically, emigration also acts as a political pressure valve, reducing domestic unrest. Instead of protesting, frustrated young Italians quietly board planes to Berlin, London, or Amsterdam. Italy bleeds its future one departure gate at a time, growing older and weaker with every exit. Italy's problems are not evenly distributed because the country is effectively split into two separate economies, drifting further apart every decade. From Milan through Venice, northern Italy is industrial, productive, and deeply connected to global supply chains. If the North were its own country, it would rank among Europe's richest regions, comparable to southern Germany or Switzerland. Travel south past Rome and the economic landscape changes dramatically. Roads deteriorate, opportunities vanish, and growth collapses. The Italian South produces barely half the income per person of the North while operating under the same currency and government. This gap is not a temporary imbalance, but a structural divide that has persisted since unification. Infrastructure promises to the South were made for generations and broken just as often. Highways, railways, and logistics projects were delayed, abandoned, or stretched across decades. The result is an economy trapped by distance, inefficiency, and isolation from modern markets. Businesses cannot scale when trucks crawl on outdated roads and ports fail to integrate into supply networks. Organized crime compounds this weakness by acting as an invisible tax on southern enterprise. Protection payments drain profits, discourage investment, and enforce fear as a business cost. Foreign companies avoid regions where contracts depend on criminal permission rather than law. With private investment suppressed, the state becomes the primary employer in many southern areas. Public jobs replace productive industry, creating dependency rather than development. Employment becomes political, exchanged for loyalty rather than earned through skill. Northern taxpayers increasingly resent subsidizing a system they see as unreformable. This resentment fuels political instability and regional hostility inside a single nation. An economy running on one strong leg and one weak leg cannot move forward efficiently. Until Italy integrates the South into a productive engine, national growth will remain permanently constrained. All these failures converge on one final constraint that shapes every Italian decision: a mountain of debt accumulated during decades when growth was faked rather than earned. Italy's public debt now approaches €3 trillion, a figure so large it stops feeling real until its consequences arrive. Measured against national output, that debt equals roughly 140% of everything Italy produces in a year. Every Italian citizen effectively carries a heavy financial burden from birth, regardless of whether they benefited from past spending. Servicing this debt consumes tens of billions annually, money that produces no schools, roads, or innovation. These interest payments are not investments, they are rent paid on yesterday's mistakes. As a result, Italy has little fiscal room to respond to crises or invest in future growth. When emergencies strike, borrowing becomes the only option, deepening the trap. This makes Italy dangerously sensitive to shifts in market confidence. Investors constantly compare Italian bonds to safer German ones, and the gap between them determines survival. When fear rises, borrowing costs spike almost instantly. A sharp increase in interest rates would overwhelm Italy's budget in months, not years. This vulnerability already pushed the country to the brink during past financial crises. Italy survived only because external institutions intervened to stabilize markets. The uncomfortable truth is that Italy is too large to fail, but also too large to rescue easily. Unlike smaller countries, Italy cannot be bailed out without threatening the entire European financial system. This reality leaves Italy suspended in a fragile balance, neither collapsing nor recovering. Growth remains weak, reforms will remain slow, and debt continues compounding quietly. Each passing year narrows the path forward while increasing the consequences of failure. Italy lives on borrowed time, hoping stability lasts longer than structural decay. Taken together, these forces trap Italy in a strange zombie state, neither collapsing dramatically nor recovering meaningfully, just drifting forward year after year with diminishing energy. The country survives by refinancing old promises, rolling debt forward, and relying on external stability rather than internal strength. Growth remains weak, but just strong enough to delay crisis and just weak enough to prevent renewal. This limbo disguises danger because this stagnation feels comfortable compared to collapse, even though it quietly erodes everything underneath. Political leaders learn to manage appearances rather than solve structural problems. Short-term fixes replace long-term reform, preserving votes while sacrificing the future. Each government inherits constraints it cannot escape and adds compromises it refuses to confront. Reform becomes politically toxic because pain is immediate while benefits arrive years later. As a result, meaningful change is endlessly postponed in favour of temporary calm. Meanwhile, private wealth cushions the decline, masking how weak the public sector has become. Italian households remain relatively wealthy, creating the illusion of national resilience. This private buffer delays urgency and reduces pressure for reform. Culture, tourism, and luxury exports continue generating revenue without transforming the underlying economy. The brand of Italy survives even as the productive core erodes. Visitors see beauty, food, and history, not stagnation debt or lost potential. This disconnect allows decline to hide behind global admiration. But museums do not innovate, and theme parks do not drive productivity growth. Without reform, tourism becomes a ceiling rather than a foundation. Italy risks becoming a country that sells memories instead of building futures. The longer this limbo lasts, the harder escape becomes. Yet history warns against writing Italy off completely, because this is a country that has reversed seemingly impossible declines before. After the devastation of the Second World War, Italy transformed itself into an industrial powerhouse in less than a generation. That recovery was built on work exports and integration into global markets, not shortcuts or illusions. Italy also possesses enormous reserves of private wealth, accumulated patiently by households over decades. Italians are cautious savers even when their government is reckless. The country remains a global leader in culture design, luxury manufacturing, and lifestyle industries. The Made in Italy label still commands trust, desire, and premium pricing around the world. These strengths represent potential, but potential alone does not create growth. To survive the 21st century, Italy would need a peaceful but ruthless internal revolution. Power would have to shift away from entrenched interests and toward younger generations. Bureaucracy would need to be simplified, digitized, and stripped of its ability to paralyze action. Labor laws would need to reward growth rather than punish it. Small firms would need pathways to scale into global champions, rather than remaining protected dwarfs. The South would need opportunity instead of subsidies and enforcement instead of tolerance. Education and innovation would need to connect directly to industry rather than exporting talent abroad. These reforms are economically obvious but politically radioactive. Any government attempting them would likely lose the next election. That political reality explains decades of hesitation better than ideology ever could. Every year, reform is delayed, the cost of change rises while the benefits shrink. Hope exists, but it demands courage Italy has not yet found. Italy now stands at a quiet crossroads where decline is slow enough to ignore, but dangerous enough to eventually become irreversible. No single reform will save the country because the crisis is systemic and layered across generations. What Italy faces is not collapse by explosion, but erosion by comfort, delay, and avoidance. The greatest risk is not chaos or revolution, but the gradual normalization of stagnation. Each year without decisive change makes the next year's reforms more painful and less effective. Demographics will continue to worsen, debt will compound, and productivity will remain trapped unless the system is broken open. The euro did not doom Italy, but it removed the final illusion that allowed weakness to hide. The era of shortcuts is over, and the price of pretending otherwise keeps rising. Italy must choose between transformation and slow Venetian-style decline. A country built on empire, industry, and innovation cannot survive by selling postcards forever. This is not a question of ideology, but of arithmetic and time. The longer action is postponed, the narrower the path forward becomes. Reform will anger powerful groups, break habits, and end political careers. But refusing reform guarantees a future defined by irrelevance rather than renewal. Italy still has talent, culture, and wealth, but none of these substitute for functioning institutions. History remembers nations that adapt and forgets those that cling to past glory. The choice belongs to Italy, not to markets, Brussels, or our fate. The clock has been ringing for decades, and silence is no longer an option. Whether Italy rises again or drifts into managed decline depends on courage, not nostalgia. The party ended long ago, and what happens next will define the century.